Ladies and gentlemen, Jonathon Reyes.
It's a real honor, I think, to be here and talk to people who, what I do for a living, invest money, actually has an impact on how they live their life. And really thanks a lot to Context Capital and Securitas for having me here. I'm going to unpack, I think, a little bit of what they're talking about into their overall portfolio, just focusing on infrastructure, which is a passion of mine. I've been doing it for 20 years now, investing. And so infrastructure, though, overall, it can mean a lot of things to different people. And one of the charts here, and I think some of these charts might be hard, so I'll tell the story. I think it's easier anyway. Infrastructure, when we think through the lineage of it, it really started back in the late 90s investing, and its birthplace was Australia. That's why I'm here doing it as well. Australia does a lot of things reasonably well. One of them is investing, actually, and I think that in infrastructure was really the birthplace of investing was here in Australia. And it started out, if you look back in the late 90s, it was just on this focus of what we call essential infrastructure, monopolistic assets, heavily regulated, real inflation protection. And what we're talking about there is just your toll roads, your airports, your poles and wires, some mobile communication tower business. And that's really it. It wasn't a whole lot there, right? But what we would call the good stuff, there was, fund managers being fund managers, there's ended up being a lot more demand for this than there was supply, right? These early investors, if you were investing into infrastructure back in the early, in the 90s, you had phenomenal returns, right? More demand came in, and they started to expand what they called infrastructure to where we sit today, especially on the private equity side. What's in these big industry super funds, a lot part of it is, it's a gray line between, is it private equity or is it infrastructure? Are these industrial companies or the infrastructure? How much of it is regulated? How much inflation protection am I really getting? On the listed side, however, we've done the exact opposite. It started out being a thematic, companies that built and designed infrastructure, but now it's gone into the point where we really have an opportunity today, and what we're doing here at Ausbil and what we're doing within the portfolios here at Securitas is this back to basics approach. All we're doing here is focusing on just those original assets that investors ultimately sought for. Just the airports and toll roads, just poles and wires, just the fully regulated monopolistic inflation protected assets. And the reason is that what Chris was talking about before is what we're really trying to do is add that diversifier to the portfolio. There's no real reason to add infrastructure to your portfolio if all you're going to get is what you're going to get in the ASX 200 anyway, right? And so for us, if you look at the top here, it's a bit hard, but the blue line is what we get out of the listed infrastructure space. The green is the private equity side, what they mark to market, and we can walk through some of those disclosures. And then at the bottom is what you can get out of different flavors of infrastructure, right? So the black bar is global equities and the gray is an S&P infrastructure indice. So how you define it dictates a huge amount of your returns, right? And so what we're really trying to do is, if you focus on that back to basics approach, you can really have a big diversifier benefit for your portfolio, and it can add in a lot of returns that you wouldn't otherwise get in different type of markets. But we often get a lot of conversation and talking points around, well, industry super, it's unlisted, what happens, the private equity, a lot of people, there's a big demand for that. And the listed side, it's shrinking overall, certainly as in Australia, when we think through Sydney Airport's gone, Spark, AusNet, just recently. But when I moved to Australia in 2008, there was over 20 publicly traded infrastructure companies on the ASX. Now there's 3, right? A huge amount of these have been taken over by the industry super funds, and they're managing them for those clients there on that basis. But what's missed is that globally, there still is the space is growing. So this is an Australian phenomenon growing, but overall globally, we're still seeing, overall the universe, 11, 10, 12 per annum of new infrastructure companies coming in the listed market. And the reason is that the listed space is significantly larger than the private equity space for infrastructure. It's about 5 times bigger. The majority of the companies in these assets sit globally on the publicly traded exchanges. And that's because they're national monopolies. That's because most of the governments still want them to have their investors having access to it. but there's still this underlying put underneath it in the context of the amounts of M&A. If you look between 2020 and 2021, you had 15 companies taken private, right? And this is a relatively narrow space. But the important part is, what are they paying for them? So these industry funds that are charging for infrastructure assets, the average premium they've been paying is 37%. And then they start charging fees on top of that, on assets that they could have already had, right? We own Sydney Airport in our portfolio for the past 15 years. And we got a great return out of it for our investors. And then they had a big that came through, and we sold it to them at a almost a 60% premium. And then they start charging their investors at that time. For us in the listed space, we can recycle that, and now we can be buying assets in France. We own Charles de Gaulle. So those of you using the model portfolio here at Securitas, we have Charles de Gaulle Airport, we have Madrid, we have Barcelona, we have Auckland Airport, we have London Heathrow, with JFK in New York. We can get access and exposure to all these assets at significant discounts than what you're going to get in the private space. And it's been very, very persistent. This is over the past 4 years, but if you look even longer, in my entire time I've been here in Australia, this is an ongoing gap. So the gap between the average price that infrastructure trades on in the public market and the average price that infrastructure is taken over in the private market has been a consistent wedge. And that's a feature, not a bug, I think, for these type of portfolios. It's something, I think, exactly what Chris was talking to is on the property markets, we see it in the infrastructure markets as well. And when you have this valuation gap that sits there, it's something that we want to express it in our clients' portfolios. So we have an opportunity to have diversification benefits at a cheaper valuation point. And it's something where we don't think this trend is going away. Industry funds aren't going to get smaller, right? They're not going to get small. They're going to keep getting bigger and bigger, and it's going to be boutique investors. It's going to be people that have financial advice that can arbitrage that valuation gap and take advantage of it. But they're still going to gather a lot of assets in between, and it's a real strong point for what we're trying to do. Just on I think Chris and I didn't compare notes, but there is a lot of similarities, and the other one is on net zero. I think it's really important when you think through. I mean, I think, Chris mentioned a lot of things that we echo as well, in that the goal for net zero is exactly that's a goal. I think there's going to absolutely be a lot of places, a lot of countries that have no chance of achieving net zero, right? And whether you believe it or not, it's been politicized. It's not really for us to say, but what's important is that every country, especially in the developed world, but every country globally is going to be investing capital to get closer to that goal. And we want to be able to be a winner of that, not a loser, right? So there's going to be winners and losers that come out of this. And this chart here just shows what's going to be able to spend. It doesn't really matter who you use. You can use Morgan Stanley or Goldman Sachs. This is Goldman Sachs here. But they have a $3 trillion CapEx spend on net zero ambitions that we have. But the point what we're trying to make on the infrastructure side is it doesn't really matter what that number is. About half of it sits right in the wheelhouse of what we're doing in infrastructure space. And that's the poles and wires and adding clean renewable energies to the overall fuel mix of the economy. And those are it, so the rest of the stuff, yes, it's important to have charging stations. Yes, it's important to have different technologies. But what we're trying to focus on is those regulated utilities that provide inflation protection, but still have exposure to this huge secular theme. People within our space, we get very excited about growth because our asset class can be boring at times, right? We're the stable, predictable, inflation protected asset, but this is an enormous growth context. Half of a $3 trillion spend, that's $1.5 trillion. The cumulative market cap for all of infrastructure in the listed space is only about $2.5 trillion. It's an enormous quantum of capital that's coming into this space. So we have, in the listed space, you have net buyers from the industry funds, but then we have this huge amount of growth opportunity that's coming in from this energy transition. And the part about the energy transition that's super, what we're very, very focused on is what's called the energy trilemma. And now I'm getting a bit in the weeds, forgive me if I'm a bit nerdy on it, but this is something that we're hypersensitive to because the energy trilemma is something that's happened my entire career. 20 years ago, I was investing in utilities in New York, and companies were talking about this then, right? And it's about this delicate balancing act of sometimes competing forces where you're trying to balance reliability and affordability and decarbonizing at the same time. right? And it's very, very challenging. And overall, most places, most jurisdictions, most companies, most countries, for that matter, are doing two of these three things, right? You either have a very low-cost, reliable energy, grid that's really carbon intensive, or you have a very low-carbon, affordable grid that has reliability issues, or you can have reliability be important, and it can be extreme, net zero already today, but extremely expensive, right? Very few places are able to do all three, right? And where we find those, we really want to express it. So we run, concentrated funds, and there are places in the world that do this. Florida is a great example of a place that has all three of these working. But what it becomes is a feedback loop, both positive and negative. If you're on the wrong side of this, and this is something where AGL, for example, here in Australia is on the wrong side of this. They're just too far over their skis with coal. And for them to decarbonize, it's impossible. They have zero chance to be net zero, right? It's impossible for them to be that way. And so what they end up having is it's relatively expensive. So they have a relatively expensive, extremely carbon intensive, but reliable network, right? But they have two strikes against them. So for us, when we're trying to focus on capital, it's around this lens that we look through where we're trying to find somebody that solves all three of these. And when you have that, you get this positive feedback loop. And it's a real challenge, and it takes the whole world. There's only about 10, 15 companies in the world that are doing all three of these things. It's not obvious to everybody, but this is going to be a bigger and bigger issue. But importantly for us is that when we're thinking through it in the infrastructure sleeve that you have, and what Chris and Chris are doing here with Context Capital and Securitas, we're there as a small percentage of your portfolio, adding that diversification benefit. So whilst we like this energy thematic and the energy transition opportunities, we're not compromising on the infrastructure characteristics that we're there to do, right? We know the role in the portfolio we're there to do. We're there to have that high predictable cash flows, the downside risk, little commodity sensitivity, monopolistic characteristics, all of that stuff we're still getting with this energy transition. So we're really focused on, like Turner is the electricity grid of Italy. So you guys as investors, you're investing in the electricity grid of Italy, you're investing in Ørsted, the largest offshore wind provider. Ilia is the electricity grid in Belgium and Germany. It's a great example because for us, the grids are enormously important. There's a reason why all the grids were taken private in Australia in a really short order, because they're the ones connecting all of the clean energy to the grids, right? And so it doesn't matter. You don't have to take technology risks. Is it going to be hydrogen, ammonium, offshore wind, onshore wind, solar, battery? What's that combination going to be? If you own the grid, you're not taking any of those risks, right? It doesn't really matter to you. You just need to add clean energy to it. And so for us, Ilia was one that we increased and added to the portfolio. It owns the German electricity grid. So as the Ukraine-Russian conflict happened, Germany lost 40% of their fuel supply, gas from Russia. But you want to be closer to the epicenter because they're going to have the biggest transformation, right? So they're going to have the most money to invest. It's been a fantastic investment for us. But that's in your portfolio as well, as long as some of these U.S. companies that we have also. But it's really important that the role the infrastructure play, you don't creep. And we're not investing in this energy transition, but owning Tesla or owning an AGL or something that doesn't have those type of inflation-protected assets that sit underneath it. Which gets to where are we sitting? And I think that the overall, I think one of the big parts, infrastructure is very much macro exposed. And so for us, we're sitting here today, we think we are at peaking inflation. Whilst inflation is high today, we think we're peaking. We don't think trajectory is going up from here. We think we're going to be plateauing or down the next move, which means the back end of the curve is likely peaking as well. The next move is likely to be down, not up. We had a rate increase here on the short end, but as long as central banks stay data dependent, meaning that they're going to be raising rates to combat inflation, that's really constructive for us. That's the main part about it, but we think we're peaking. And as an outsource, the US dollar is going to be probably pretty weak. Aussie dollar should be pretty strong against that backdrop as well. Our economy is staying very strong and healthy. We also, and what Chris said is exactly, there's a lot of things that resonate. I feel like sometimes he's in our investment committees too, because cash is a real opportunity. Now all of a sudden taking risk becomes, we don't need to take that much risk, but also a lot of companies are going to be harder and harder to find growth. So what was easier growth to have because there was, your cost of capital was zero and companies were just putting a lot of access to work, now becomes harder. So we're trying to find those structural growth against this backdrop of inflation. And one of them is China's reopening. And overall, it's been really slow. People are starting, they talk about it. We had 3 years of lockdown. From our perspective, on a longer term game, it's a no-brainer. Of course, China's going to participate in the global economy again. Right, so we think Auckland Airport, for example, they had 40 flights a week to mainland China pre-COVID. They had 0 for 3 years. Today there's about 10. Right, there'll be 25 by the year end, and there'll be 40 over 40 next year. Right, so that's not a bridge too far for us. So for patient investors to say, well, I'm willing to wait a year, airports are already at or above pre-COVID levels for most of the European assets without China. Right, that's a big caveat. And so we think there's still a big opportunity there. They're not priced accordingly. And the other one is just finding the secular growth. Like we talked about, the energy transition is a huge player in that part. But when we speak about, what are we doing from an inflation perspective specifically, these charts are all challenging to read, I know, but what we have here is the difference between infrastructure performance versus global equities performance annualized in different interest rate environments. And the main thing is when inflation's above trend and increasing, infrastructure outperforms about 8.5% per annum. When it's above trend and decreasing, it outperforms by about 8% per annum. The whole point of it is when inflation's above trend, infrastructure has outperformed the global equities for the past 20 years. This is why you own our asset class. And overall, it's something that's a feature. It's why. Why is that the case? It was because when you own a toll road, for example, when you drive on the road, the tolls go up by CPI every quarter, right? It's not, you don't have to negotiate with anybody. You don't have to raise your prices and hope that the consumer comes. It's a mechanism that comes through. You're regulated, your rates, our rates, Western Power's rates that are here, they're going up by inflation. Whether we like it or not, the rates are going higher. Right? And so we want to own and be exposed to these type of assets and be a feature in the portfolio. And this is where we add that diversification benefit. Some companies are going to struggle in these environments. Right? It's going to be harder to find staff. It's going to be harder to pass through prices to consumers. Infrastructure, this is where our bread gets buttered, is when inflation is high. We want to play this role. And in saying so, for us, a snapshot of what we're doing, it comes back to the start on that back to basics approach. The way we define infrastructure here is about 95% of our portfolio has the ability to capture inflation and pass it through. Right? That's through regulatory mechanisms, that's through these concession frameworks, that's through escalators built into contracts. And this is about as good as you're going to get, really, in the equity world. In the fixed income world, there's inflation protected bonds, but for the most part, this is really why you own us and how you're going to get there. So overall, the role we're playing, again, niche in your portfolio, just to try to unpack a little bit of what's underneath the hood. You got these big portfolios, you have a lot of different holdings. What you're getting out of your infrastructure sleeve is really this inflation protected bend here. Again, Turner, the Italian road network. We have Atlas Arteria that owns the French road network type of holdings. Pinon's a UK water utility. But importantly, we have these energy transition. We've caveated it between the US and Europe because they have different streams, especially after the Russian-Ukraine conflict. But overall, some of the biggest power out. NextEra is the biggest renewable energy generator in the world, right? That's in our portfolio. It's one of the top 5 holdings since inception. We have, in the repowering Europe side, we have, again, offshore wind with Ørsted, Ilia, German grid, but probably a second derivative is Cheniere, which owns LNG assets in the US that's supplying and basically backfilling the loss of demand from Russia. And so those are really important plays. And again, back to the COVID recovery, there's a lot of prime assets that we can have in this portfolio. ADP, Airports de Paris, it owns Charles de Gaulle. For example, again, in this portfolio, you have Charles de Gaulle, Madrid, Barcelona, London Heathrow, Gatwick, JFK. All of these are being representative of our portfolio. Transurban, which is probably, most people would be recognized here, but the flagship road company globally. Another one, Getlink, which owns the Eurotunnel between France and Germany. But these are really all of the things that we have this exposure to, we think are underappreciated in the market and still have a long way to go, and still are able to provide that kind of stability in these portfolios during these periods of time. So hopefully that's helpful, I think, just to bring some life about some of the opportunities. And I know Chris and the rest of Context Capital and Securitas have a lot of different investors. And one of the things that's really exciting for me is they find people that are passionate about what they do in their small portion of your portfolio, and we're able to deliver some type of benefit for you, hopefully over a longer period of time. But that's what I had for the presentation. I think we're open for Q&A from here.